Okay, Marty says, would you do a quick run through of the trade simulator and radioactive trading? Of course. Now, if you go to the radioactivetrading.com, where you see the information about the blueprint, this free white paper, the sketch, of course, is there as well. But if we go into the resources tab, we can see access to the trade simulator tool. Trade simulator tool is essentially a simulation where I can put in my expectations for a given strategy. What do I expect my average return on winners to be? How am I going to try to control my average loss on losers? How much am I going to invest in this strategy? And if I invested a certain amount, how many trades am I going to open? And then the system flips a coin, Marty, 100 times. Heads, we win. Tails, we lose. We lose the amount we said we would. Here's 10%, 10%. And heads or tails. So what is this looking at? This is essentially what an investor might look at for just buying stock. What do I mean by that? Well, if I'm just trading stocks, no options involved, I might have a target price to close my stocks. If I hit a target of 10% gain, I might put in a stop loss at 10%. Hey, depending on market conditions, regardless of what criteria I'm using, 50% of the time they go up, 50% of the time they come down. I'm going to hit $10,000. I'm going to invest $5,000 into each position. So 50-50 every time I open a position. Let's run our simulation, flip a coin 100 times. Heads, I won 48% of the time. I lost 52% of the time. And of course, we start out with $10,000. We'd expect to lose. Okay. And you can see here, at one point, we thought we had a really good track record. So we probably had a really good string of winners. There they are, from 5 to 14. 9 wins in a row, averaging 10% on those winners. And then, of course, we had 6 losses in a row. We're right almost back to, well, no, we're still doing pretty good. But over time, it sees that. How is this useful? Well, it's to help you gauge what kind of exit strategy and management you might consider. And this has helped me when I first started not only looking at the search criteria for the bull puts and developing what we wanted for the bull puts and the bear calls, but also how to manage the spread trades. So what I was seeing on average is our average target return, we were around 14.8, 14.9%. And we were winning about 84, 85% of the time. I'm sorry, reverse it. Probability of loss. So we're winning about, let's say, 85% of the time. So we're losing 15%. And let's say I opened a bull put credit spread portfolio, took 10% of my portfolio, $10,000. I'm going to allocate it to spreads. And my plan was to open, let's say, 4 trades each cycle. So I'm going to allocate 25% of that $10,000 into each credit spread. Okay, now, we know we can lose 100% on a credit spread, right? So long term, if I'm right, hey, 89% of the time, not really ahead, am I? I'm up 7%. That doesn't sound right. Let's go ahead and run it again. 88%, no, I'm down again. 83%, I'm getting squashed. Okay, what does that mean? That means you can't allow on a leveraged spread trade, bull put credit, bear call credit, even an iron condor, you cannot let it go to full loss. But we also know options trading. I know that I can't say, hey, I'm opening a credit spread where I'm getting a 50-cent net credit, or in this case, I'm sorry, it'd be closer to 65, 60-cent net credit on a 5-point spread for my 14, 15% return. So the true maximum loss, Marty, in that case, if we're taking in 60 cents on 5 points, is 440. I can't set a 10% stop loss. That's 40 cents. I've got that when I open the trade. I can't do 20%. That's 80 cents, right? Roughly 88 cents. That's probably, if the stock even pulls back 1%, it's going to cost me 88 cents to close the position. I'm going to be closing 90% of my trades. I can't control the spread loss to 20% of the maximum loss, 30. What about 50? Oh, not 250. What about 50? I open a spread again where I'm taking in a 60-cent net credit on a 5-point spread. So my maximum loss here is 440. That's the 100% loss. I keep this 60 cents that I got regardless of what happens on our 5-point spread. The true risk is 440. What if I control that to 50%? I only allow it to be 220 on a 5-point spread. Okay. How is that going to work out if I'm able to keep the same average return on the winners, 14.8%, keeping my probability at 85%, where on average, that, it's around 86.3% winners from 2015 and on. All right, so let me do that. Here at only an 80% win ratio, which is still pretty good, but I'm targeting 85. At one point, we did have about a 14, 15% drawdown, but still about a 26% return. That's pretty good. 86%, that's what I'm looking for. 84, 85, 86%. That's showing me what I want after 100 trades. 84, still pretty good. Still where I want to be, right in the wheelhouse. Now, we saw where we would be at 80%. We were at a win of about 2,600, 26%. We saw about 35%, or I'm sorry, taking the 10,000 up to 35, and here taking 10,000 up to 25 with an 84% win. The 35 was at, 86%. Let me allow this to go to 70. Okay? 84% win ratio. I'm at a loss. I didn't take my $10,000 and almost double it. Same target return. Same win ratio, 85, 84% winners. Same allocation. I cannot let the loss limit go beyond 50%. And I can't put my stop on the spread loss at 20 or 30% because I'd be closing out 70 to 80% of my trades for that 20 or 30% loss. Okay? This is what helped us discover the balance. And you can use this with any structure. So I'm thinking about doing covered calls. I know that I'm going to be looking for a 3% return if assigned, maybe on a 1 month out covered call. I know I'm going to expect to be right. Let's just say 65% of the time. I'm going to take $10,000 and use 50%. Is using a 10% stop on a covered call a good idea? Nope. Here I'm right 57% of the time, not close to the 65 I wanted, so that is a little bit low. We're down 75% from where we started. Okay, let's get a good, there we go. 10% stop, allowing the losers to go to 10% while winning 3% when I'm right, and that's the max return on a covered call. Let's say, Marty, if I get assigned, I'm right 66% of the time. I'm still down 54%, 53%, not cutting it. I probably want to use a 7% stop order. No, still not cutting it. Didn't do it 66% of the time. Okay, and 71. So what does that tell us now? Well, if I put the loss at 5%, I'm going to be closing some of those covered calls more frequently. It's not a bad idea to control the risk. What it also tells me is I'm probably going to need to be right. Why am I focusing on 7%? 7%, that popular approach used by Will Neal at Investors Business Daily. It's a common stop order to use on a stock, covered call, or naked put position, 7%. But even with that, what you start to see is that you're going to need to be right. To get the return you want with covered calls, you're going to need to be right 75, 80% of the time. Targeting a 3% return on the covered call position. Well, allocation is also important too. And what I mean by that is if I'm doing covered calls, if I was only doing $10,000 for covered calls and I'm allocating half to each, that means I'm only trading $40 and $45 stocks, $50 stocks, right? I can't do anything higher. Not to say that, the same ratio at $100,000, if I'm right 66% of the time, you see we're still at a loss. 69, we're about still at a loss. 74, now we're doing a little bit better. That's only a 19% return. But, 20, 23%, that's kind of the expectations with covered calls over a course of a year. You could control this to a 5% loss, but then again, you might have to expect that your win rate would be lower because you'd be closing more positions. But it gets us where we want, right? 3% wins, 5% losses, right 70% of the time, 32, 33% return after 100 trades, 20, 25, 30%. Okay, it might be reasonable in a good market for covered call positions, but again, you've got to control the limits. You can't let the risk go. You can't let naked puts run, a cash secured naked put run to a 10, 12, 15% loss. You can't let the covered calls do that. It completely wipes out your track record. On a spread position, you can't allow it to go more than 50% of the loss. I'm talking about out of the money, high probability bull puts and bear calls and iron condors that have that 7-to-1, 8-to-1 risk reward ratio. Cannot let it go above 50%. And this is what the trade simulator helps you see, Marty. The effect of what if I let the loss go too big? how drastically it changes what your expectations were and hopes were for a strategy approach. You are going to have losses. You're going to need to manage those losses, but you're also going to want to know where can you set your losses. And of course, the idea that we show this in is that, hey, now that we've shown what a covered call can and can't do, let's keep the same thing. Let's say that what if I had a 6.4% win ratio and I kept my losses to 4.7, 4.8%, and I'm right just 50% of the time, same $100,000 allocation. That's a 50% return. Right, 53% of the time, it's a 69% return. Where are these numbers coming from? Well, these numbers are sort of coming from, and it's actually but 6.4% wins. Okay, I'm sorry. It's 6.3% average on the winners, 5% on the losers, but it's not a 50-50 win ratio 60% of the time. This is the average win-loss ratio, and I'm sorry, average win on the winners and the losers for the 80 trades I've done in the married put portfolio on Fusion since 2008. Ernie's is more of 50-50. I use 50-50 in that simulation we just showed, but mine's 60-40, 60 winners, 60% winners, 40% losers. Ernie's 50-50, but he's got a better average win ratio. He's up at about 10, 11% while keeping his losses to 5.2. Oh, he's back up now. Good. He was 50-50 earlier. He's at 55% winners now and 45% losers. But again, he's got a much better average gain on winners than I do. He holds positions longer and milks them further. I tend to get out sooner than he does if I don't like where it's going and try to find a trade that's going in a better direction. But that, again, shows you sort of what you can expect expectation-wise. What are some of the advantages that married put approach? Well, that's sort of Ernie's numbers there, but you see that you can have, this is back to 10,000, of course, but you can see you can have a good return even with a losing track record. You don't really see that, and even this is higher, going 5% and 10%. You don't see those same numbers even with controlling the risk and hoping. Remember, in a covered call or in a bull put credit spread I was discussing, how do you limit the loss? You have to use a stop order. That's not a guarantee like the married put or the collar approach is in those cases. What did we have here on credit spreads? 15, 50, and 80. Yeah, so that's pretty close in what we're looking at here. And you can see here, if I've got a 77% win ratio, I didn't hit the 80% target I'm looking for. Wow. At one point, we thought we had a really, really good system, but a long term can end up bankrupt. And that went up to 70%, so we should probably drop that down to 50. But in any case, that's how you use the tool, Marty. That's how it helps you with the decision-making process in those cases. It's to not only help you develop, the main reason is to help you develop and see the benefits of using the protected married put positions or the collars where it has a guaranteed low limit, but also the risks of using certain strategies if you don't control the risk. It's not just about having an 85, 90% success rate on credit spreads or calendar spreads. It's about knowing how you have to control your risk, and you can't let those go to 100% loss, because you can be right 90% of the time and making 8 or 10% on credit spreads. But if you're allowing 100% losses, you're going to lose. Even with an 89, 88, 90% success rate, you're going to lose long term. You have to see where you need to set your stops so that you can still hit your target goals that you would want to see long term. So it illustrates the benefit of protection. It helps you develop what kind of stop or what kind of stop loss order you might want to use in certain strategies as you roll that over time. And again, it can also help you develop the other benefits of, do I really have a winning structure that I'm using for these positions?